Right, the second video that you would have just watched was basically giving you an idea of the theory of what you have to do when that unguaranteed residual value changes. And the main principle is you need to go back to the beginning of this lease and redo your calculations to see what the balances would be today. So that is not probably the most prudent way to approach it in assessment. There will be shorter ways to do that. I mean, you're changing one variable, so on your calculator you'd have your amounts keyed in with the future value used up to date, and it'll essentially be a case just change that future value to what it is now with the revised unguaranteed residual value, and then you can pull out using your amortization function all the balances that you do need. So let's go ahead. This spreadsheet will probably then represent more the kind of scenario that you'd want to follow in your assessments, perhaps a little bit more detailed just to keep the explanation going. But what you're looking at now is there are two balance sheet accounts, statement of financial position accounts, that are affected by this lease: the gross investment and the unearned finance income. So you want to work out now your changes in 2013, at the beginning of the 2013 year. That's the period that you're looking at. That's when the change happened, the first day. So your closing balances 20x12 will be the opening balances for 20x13. So you could go back to video 1 to 4 or to the previous one of this session of videos for today and just get those balances from the journal entries. So to summarize them, your gross investment was recognized initially at 320 with a payment at the end of 50,000. So you know that your general ledger balance for this account at this point would be 270,000. Your unearned finance income, according to the initial recognition journal, was measured at 118,000 Rand, and you recognized out of that and realized out of that 30,451 Rand, which would give you the balance on that account at the end of that reporting period and the opening balance for this reporting period of 87549. Now what you need to know is, what are those revised balances? What would they have been if I had done it with this change in estimate since the very beginning? Well, your calculation, again, if you go back to the previous video, would be a case of saying, right, the gross investment in that was 288 because I used a different unguaranteed residual value. The 50,000 payment still happened at the end of the year. So my balance on my gross investment should now be 238,000 if I had used that initial estimate. Likewise, with your unearned finance income, go back to the previous video. What was the initial recognition balance on that? And you will see that that was 86,000. Using your amortization function and looking at your subsequent journals, there was an amount of 24,166 realized of that, meaning your balance would then have been 61834. So go back to the last video if you're uncertain about where I get these amounts from. Go back to the first 4 videos done yesterday for those lectures. It's the same sum. You've just changed the one variable, but you followed the same procedure. What you're looking for is getting what is in your ledger, what has been accounted for. Then you're going to step back and say, right, what would I have accounted for? And if you know these two columns, it's very much a case of getting the difference between the two of them to work out what journal entry is required. Because you need to change what is the existing, the yellow column on your screen, to what it should be, which is the green column on the screen. And to achieve that, it's just an adjusting journal with the amounts that I've shown now on the screen to you there. Yeah, those two amounts differ, and the reason for that is because there's interest that would be different. Your finance income recognized last year is not the same. If you look in those two journals last year, the finance income changes. So catch it up, put it into finance income this year, the difference between these two amounts. I'll give you the journal just now. Let's just consider how we could have calculated all of this now without using the previous video and redoing everything, and get to your answers quicker. So understanding the basics of what we're trying to achieve with this unguaranteed residual value, let's go into the actual memo from this assessment, because this is sort of what you'd be expected to do and what we think would be the quickest way to get to your answer in the test. Remember the scenario now again. You have done part A to see the first 4 videos from yesterday. That was asked, you had calculated the balances at the end of 2012. Now, at the beginning of 2013, there's a change in one of the estimates being the unguaranteed residual value. So you already know from doing the previous calculations referred to what the balances, what your existing balances would be in the general ledger. So if you're sitting in your assessment now, from the previous part of the question that you've just answered, take those balances, deduce them from the journals that you did, and bring them down into this part. And we've had a look at where I get them from. It's the initial recognition minus the subsequent journals. They have the unearned finance income on your screen, and you have your gross investment on your screen. And they give you the calculation instructions here now as well for your two calculators that are prescribed. Then what we've said is you need to know what those are, and you need to know what they should be. So, like we've said, recalculate it. Just change that one variable. Go into your calculator. There's the calculator instructions now on your screen, and there you'll see the difference. It's exactly as you had done in the first few videos. All that's changed now is go and change that future value. Once these variables are in your calculation, use your mod function, just as you did in the first 4 videos, and now you can calculate now what these balances would be. Remembering that one time period has passed, so if you tell your calculator to give you the time period 2 to 5, it will give you the balances remaining for these 2 accounts, which is very useful and much quicker than trying to redo everything as we've done up to this point. And once you've got those balances, you've got your existing balances from the first part of the question, you've just calculated the revised balances by simply going to your calculator, changing the future value variable, rerunning your amortization, using your periods. It's for period 2 to 5 because 1 was in the previous year. You want to know the balance now, what it would be. If this is confusing, just recalculate it like we've done earlier on, and you'll still get the same balances and be able to work out your differences. Then once you know what the differences are in the balances for those 2 accounts, just ask yourself, what do I need to do? Well, my gross investment, traditionally a debit balance, now needs to decrease with a 32,000. The estimate changed from 40 to 8. So that makes sense on the credit side. It's a mark everybody should be able to get. Then the unearned finance income, it's again just the change in your balance. Your unearned finance income, traditionally a credit balance. What was it? What should it be now? We need to decrease it to what it should be now, the 61. So put the difference through on the debit side. And to balance this whole journal off, catch up the change in the finance income with an adjustment through to profit and loss finance income. And that really is that. I think spend time redoing the calculations that we've done earlier on in this video. See how we got those balances. Spend time now with your calculator working out as we've done in this example. And you really should be okay. It's not the biggest rocket science on earth. To recap, what was the balance? Recalculate the balance with that one changed variable and put a journal through for the difference. I hope this video is going to help you come right with this. If you have any questions, please pop me an email. I'll get back to you and we solve them as we go. Hopefully the disturbances are solved soon on campus and we can get down to business again. And then any questions that you may still have, we'll address them.